Hi everybody! Did you ever notice that in 2023, while banks all across the world were failing, not a single Indian bank failed or faced a crisis. In fact, our banks were growing at a staggering rate during the exact same time.
I want to briefly speak about what's happening in Silicon Valley Bank and Signature Bank.
The abrupt closures of three banks in a matter of days that are now sending shockwaves across sectors of the economy and raising concerns about the U.S. banking system.
State Bank of India has gained 20% from its low.
Indian banking system is quite resilient.
Strong loan growth, higher yields and lower credit cost ensured that FY23 was the most profitable year for India's banking sector.
But you know what? Indian banks were not always so robust, and you would be shocked to know that there was a time when Indian banks used to fail like a house of cards. In fact, after the 2008 crisis, along with all the scams that were happening, India was also witnessing a banking crisis. And all of this came to surface in 2018 with the Punjab National Bank crisis.
करीब 11,500 करोड़ रुपए का फर्जी घोटाला।
पंजाब नेशनल बैंक में 10,000 करोड़ का ये घोटाला मुंबई की एक ब्रांच में हुआ है।
किस हाई लेवल तक हेरा फेरी होती है? 11,500 करोड़ रुपए। देश के सबसे बड़े सरकारी बैंकों में शामिल पंजाब नेशनल बैंक में इस फर्जी ट्रांजैक्शन का मामला सामने आया है।
11,500 करोड़ जनता का पैसा नीरव मोदी और मेहुल चौकसी के जिम्मे करने वाले, ये आप देख रहे हैं इन तस्वीरों को।
Steps are being taken to this. The ministry has taken note of this, and certain steps are being taken.
And this is why, ladies and gentlemen, a very important chapter of the Indian economy was written by the Reserve Bank of India. So the question is, suddenly from 2018 to 2024, how did we go from facing a banking crisis to becoming an expert in avoiding a banking crisis? While so many banks all across the world were failing, how did Indian banks stand strong even during the pandemic and the global economic crisis? And most importantly, what on earth did the Reserve Bank of India do to protect your money? But before we move on, I want to quickly thank our partners of today's episode, and that is Growth School. People, major countries like UK and Japan are already in recession. Moreover, even in US, the biggest tech giants like Google, Microsoft and Amazon, they've laid off thousands of people. The World Economic Forum has estimated that more than 85 million people will lose their jobs by 2025 merely due to AI. So during this time, instead of fearing AI, you must embrace AI. And if you want to learn AI, ChatGPT and 20 plus tools like Midjourney, InVideo and Claude AI, you must join Growth School's workshop. This workshop is actually a paid workshop, but for Think School viewers specifically, this is completely free. Not just that, the first 1,000 people who register using the link in the description will also get a bonus worth 5,000 rupees, which includes 50 plus AI tools and their use cases and 250 plus prompts that you can use in your daily life at no cost at all. More than 1 million people across the world, including myself, have taken this workshop, and I have seen some extraordinary result in my daily life. So whether you are a data or tech professional, a freelancer, a business owner, a founder, marketer or any other non-tech role, this workshop will be an absolute game changer for your everyday work. So go ahead and register for this Growth School workshop now. For this economic case study, we are using the reference of these amazing research papers from the Columbia University and the Center for Social and Economic Progress. Chalo, let's start from the basics. In the banking space, there is an important term called the non-performing asset. In simple words, if a bank gives out 10 crore rupees in loans and understands that 2 crore worth of loans will never be repaid, this 2 crore rupees is considered to be a non-performing asset. In percentage, 2 out of 10 crore rupees, as in 20% of the loans are non-performing assets. So if the NPAs are high, it means that the banks are not doing well. Now, if you look at this graph, in 1992, the situation of our public sector banks was so terrible that the non-performing assets, as in bad loans, were as high as 25%. But by 2008, it reduced to less than 5%. But just like we see in this graph, after the 2008 crisis, the NPAs slowly started rising again. And suddenly, from 2015 to 2018, that is in just 3 years, the NPAs shot up from less than 5% to touch 15% in 2018. So the question is, what exactly happened after 2008, and did it happen only because of the 2008 crisis? Well, as it turns out, because nobody expected the 2008 recession to happen, before 2008, the public sector banks went super bullish on lending for infrastructure and other projects. And if you look at our economy from 1991 to 2000, we saw a staggering growth. Look at this graph. From 1980 to 1990, our GDP per capita grew by just 27%. Similarly, from 1990 to 2000, it shot up by 16%. But from 2000 to 2010, it shot up by 67.2%. So in 2008, if you were a banker, you would expect the boom to continue, right? Well, this is exactly what the bankers of India thought, and they started lending very, very aggressively. In fact, according to the Center for Social and Economic Progress, a promoter confessed that he was pursued by the banks with waving checkbooks asking him to just name the amount that he wanted from the banks. And if you look at this chart, the banks were lending so fast that the total bank credit in the market shot up from 7.5 trillion in 2002 to 15 trillion in 2005 to 33 trillion in 2009. And the annual expansion of credit accelerated from 15.2% in 2002 to 31.4% in 2005. So in short, the market was flooded with money from 2003 to 2008. And this is why, ladies and gentlemen, something crazy happened. Now, before we move to the next segment, you need to know how the banks under the RBI categorize their loans. So let's dive into it. You see, the RBI instructs banks to sort their loans into standard and non-performing groups. Standard loans are essentially the safe bets where there is a very slim chance that the borrower will default. On the flip side, non-performing loans are those loans where the borrower is struggling to meet interest or principal payments. So in short, these loans are at a risk of default. Now, these non-performing loans get further broken down into subcategories, and these subcategories are substandard, where a borrower has defaulted for less than 12 months, doubtful, when the loan has not been paid back for more than a year and the recovery is expected to happen at a loss, and loss loans, where the bank expects to incur a loss for sure. If you've understood this, let's come back to what happened after 2008. In August 2008, which is just 1 month before the stock market crash of 2008, the Reserve Bank of India introduced a rule called Asset Quality Forbearance. And as usual, this might sound like a boring banking term, but let's make it super simple for you and understand this using a story. Let's say Think Private Limited starts missing loan payments and doesn't pay the EMI for 90 days. So according to the rules, the loan is classified as a non-performing asset. Now usually the RBI says that every time someone defaults, the banks have to keep aside a certain amount of money that they cannot lend or use it for money-making purposes. In this case, for simplicity purpose, let's assume that the RBI stated that 15% of the outstanding loan amount of your NPA must be kept aside. So after a year of repayment, if Think School Private Limited has an outstanding loan of 8 lakh rupees and then it defaults, according to the regulation, 15% of 8 lakh rupees needs to be kept aside by the bank. So 1.2 lakh rupees needs to be kept aside in the bank reserves. And this 1.2 lakh rupees cannot be used for lending or other income generating activities. This is how RBI makes sure that the banks set aside a certain amount of money so that they do not go bankrupt themselves. And this is where the forbearance rule came in. Because of this rule, banks did not have to classify bad loans as substandard loans at all. And since they did not have to classify it as substandard loans, they did not have to keep aside this 1.2 lakh rupees in reserves. So even when people were defaulting, the banks could give out more loans to businesses. This is the reason why the loans that should have been marked as high risk were labeled as restructured. As a result, the banks kept on lending and they got into even deeper trouble. This practice of forbearance continued for 10 long years. This is how the bad loans started to become the silent killers of the Indian banking system. By the way, during this time, that is between 2008 to 2012, we also saw the scams in India which caused massive losses to the Indian economy.
2004 से 14 इतने सारे घोटाले, भारत की अर्थव्यवस्था खस्ता हाल हो गई. टोटल लगाया तो 12 लाख करोड़ के बाद मैंने टोटल छोड़ दिया.
So the CBI today filed a new first information report in yet another scam in the Commonwealth Games saga.
The CBI has filed an FIR against former Antariksh Executive Director and directors of Devas Multimedia.
कोल स्कैम के द्वारा भारत देश का भयंकर नुकसान किया.
The Adarsh fallout. It's been 3 months since the scam broke. A building meant for defense personnel grabbed by politicians and bureaucrats.
This is when Dr. Rajan became the governor of India, and when he reviewed the hidden NPAs of the Indian banks, he found something absolutely shocking. He saw that even though the NPAs in the public sector banks were rising, they were completely hidden in plain sight. And when the asset quality review was actually conducted, the NPAs in India started spiking from 5% in 2015 to almost 10% in 2016 to 15% in 2018. This is how our public sector banks ended up being in one of the worst states in the decade. In fact, Dr. Rajan even said that too many loans were made to well-connected promoters who have had a history of defaulting on their loans.
Former RBI Governor Raghuram Rajan said a large number of bad loans can be traced to the 2006 to the 2008 period.
Government has been putting the burden on the RBI. The government has been acting on its own.
Banks didn't have enough power to get promoters to pay or to put the stressed assets back on track. They didn't have the right kinds of tools.
Too much lending to the bad projects that need to be shut down and too little lending to viable projects that need to be supported.
So you can imagine how big the problem was. So in short, if you were to analyze this situation from a macro perspective, many loans were given when economy performed well. Then when they turned into bad loans, they were hidden due to asset forbearance rule, and very soon the NPA started rising to scary levels. This is how slowly and steadily India was inching towards a banking crisis. So the burning question over here is, what did the RBI do to save India from a banking crisis? Now this is where you will see the beauty of economics and the difficulty of running a country as massive as India. In fact, you will know why is the RBI governor deserving of a 400 crore house to stay. Anyways, let's get back. To help the public sector banks get stronger financially, the Indian government and the banks together added a huge amount of money to their funds from 2015 to 2019. In total, they added a staggering 3.19 trillion rupees, which is $38 billion. And in 2018 alone, close to 2.11 trillion rupees was put into these banks. This is how the banks started to have real cash to sustain their existence. The second thing that the government did was to merge the weak public sector banks with stronger banks. This is the reason why the number of public sector banks reduced from 27 in 2017 to just 12 banks after the merger. This way, the banks could pool their resources, operate with better efficiency, and they're able to reduce their expenses. And lastly, the Indian government introduced something called the PCA framework, or Prompt Corrective Action Framework. This framework sets guidelines based on the bank's financial health indicators, and this includes capital ratio, asset quality, profitability, and leverage. So now, if any bank crosses any threshold, the RBI will immediately take very strict action to prevent your bank from failing. This is how the RBI monitors every important bank in the country so that India does not face a financial crisis. And lastly, India implemented something called the Basel III framework, and this execution took 6 long years from 2013 to 2019. For those who don't know, Basel III is a set of international rules that tells a bank how strong and high their safety walls need to be. It's almost like international fire regulation but for banks. And this is where we get into hardcore banking concepts. So if you are interested in understanding these concepts, I'll attach a document in the study material so that you can read through it and understand this concept better. But long story short, what you need to understand is that the RBI has a double layer protection for your banks. For example, if Basel III says banks need to have 9% of the total risky loans in their reserves, RBI says that Indian banks need to have 11.5% so that our banks can stay extra safe. And the fun fact is that the banks that failed in America did not have a Basel III framework executed. So because we took the pain of implementing it for 6 long years, in 2022, when all other banks were failing, our banks did not face a crisis. And lastly, India designed a revolutionary policy called the Indian Bankruptcy Code in 2016.
The Union Cabinet has amended the Insolvency and Bankruptcy Code via the ordinance route.
The Supreme Court has upheld the Insolvency Code in entirety.
The government is looking to amend the IBC, the Bankruptcy Act.
It came at a time when the Indian banking sector was struggling with an NPA crisis.
The government dues could be low in the waterfall because whatever you give to the government, you take from the banks.
And this policy alone has saved our banks lakhs of crores in losses. Now, I've already seen your comments in the white paper video, and because of popular demand, we are making a separate video on the Indian Bankruptcy Code. So let's keep it for this time and then we'll cover it in depth in the next episode. So this is how, ladies and gentlemen, the Reserve Bank of India first faced a banking crisis, learned lessons from the crisis, and designed a super safe, super strategic framework for our banks such that even while the banks all across the world were failing, Indian banks stood tall even during the pandemic, even during the global economic crisis caused due to the Russia-Europe economic warfare. And while listening to this story, you just learned about one of the most important chapters of the economy of India. And I just hope you learned something valuable from this case study. That's all from my side for today, guys. Please find all the study materials in the description. If you learned something valuable, please make sure to hit the like button in order to make YouTube Baba happy. And for more such insightful business and political case studies, please subscribe to our channel. Thank you so much for watching. I will see you in the next one. Bye-bye.